Something changed last week. Not in the way markets usually change, with noise and volatility that fades by Friday. This was different. A regulatory approval, quiet in its delivery but profound in its implications, has set in motion a chain of events that could fundamentally alter the supply dynamics of one of the world's most misunderstood assets, silver. Not Bitcoin, not gold, silver. If you hold it, this matters. If you've been watching from the sidelines, what happens next will test whether you understand the difference between speculation and strategic positioning. And if you've never given this metal a second thought, the next few months may change that. The United States government has approved a $2.5 billion industrial silver offtake agreement. The details are technical, the language bureaucratic, but the consequence is clear. A significant portion of future silver production has just been committed to industrial use before it even leaves the ground. And with global inventories already strained, analysts are quietly asking a question most investors haven't considered. What happens when the physical metal simply isn't available? This isn't about price predictions. It's about understanding what scarcity means in a market that has operated under the assumption of abundance for decades. And it's about recognizing that the financial world is entering a period where tangible assets, real supply and demand, and the physics of production matter more than they have in a generation. Let me walk you through what's happening, why it matters, and what it means for your financial position. Whether you're already invested or trying to decide if you should be, the approval itself is straightforward. A consortium of US-based technology manufacturers, working in partnership with defense contractors and renewable energy firms, secured government backing for a multi-year silver procurement contract. The agreement locks in supply from several major mining operations, primarily in North America and allied nations. The stated purpose is national security and industrial resilience. Silver is critical for solar panel production, advanced electronics, military applications, and emerging technologies like electric vehicles and 5G infrastructure. The U.S. government, recognizing supply chain vulnerabilities exposed during recent geopolitical tensions, has moved to secure access to materials deemed strategically essential. On paper, this sounds reasonable, responsible even. A government ensuring its industries have the resources they need, but markets don't operate in isolation. Every ton of silver committed to this agreement is a ton that won't be available to refiners, mints, or investors. And the global silver market, unlike gold, operates on razor-thin surplus margins. Here's the context most people miss. Annual silver production is roughly 1 billion ounces. Industrial demand consumes about 600 million ounces. Investment demand, including coins, bars, and exchange-traded products, accounts for roughly 200 million. Jewelry and silverware take another 150 million. That leaves a surplus of around 50 million ounces annually, a buffer that looks comfortable until you realize it represents just 5% of total supply. Now remove 80 million ounces, the estimated annual impact of this new agreement, from that equation. Suddenly, the surplus isn't a surplus anymore, it's a deficit. And deficits in commodity markets don't resolve themselves gently. Silver has disappointed investors before, many times. The metal has a reputation for volatility without follow-through, for sharp rallies that collapse just as quickly. Skepticism is warranted, but dismissing this development because of past patterns would be a mistake, because the structural conditions today are unlike anything we've seen in decades. First, understand that silver exists in two markets simultaneously, the paper market and the physical market. The paper market, dominated by futures, contracts, and derivatives, is enormous. Trillions of dollars in notional value trade hands without a single ounce of metal-changing location. The physical market, where actual bars and coins move from refiners to vaults to end users, is comparatively tiny. For years, these two markets have coexisted in an uneasy balance. Paper contracts set the price, physical metal follows. But when physical supply tightens while paper contracts continue to proliferate, something has to give. And historically, when that tension breaks, it doesn't happen slowly. Second, consider the broader macroeconomic environment. Central banks have spent the last 15 years expanding their balance sheets at an unprecedented pace. The money supply has grown faster than productive output, creating inflationary pressure that policymakers have struggled to contain. Interest rates, despite recent increases, remain historically low in real terms. The purchasing power of major currencies continues to erode, not dramatically, but persistently. In this environment, hard assets become more than portfolio diversification. They become financial insurance. And silver, trading at a fraction of its inflation-adjusted all-time high, offers something rare. Industrial necessity combined with monetary characteristics, at a valuation that doesn't reflect either. Third, the supply side of silver is structurally challenged. Unlike gold, which is mined primarily for its own sake, roughly 70% of silver comes as a byproduct of copper, lead, and zinc mining. When those base metals become less profitable to extract, silver production falls regardless of silver's price. And with energy costs elevated and environmental regulations tightening, the economics of mining are under pressure globally. New mines take 7 to 10 years to bring online. Existing operations are depleting. Recycling can't fill the gap because much of the silver used in industrial applications is consumed, not recoverable. The supply response that markets expect when prices rise simply can't happen quickly. The agreement specifies delivery schedules beginning in April. That's not arbitrary. It coincides with the second quarter, historically a period of increased industrial demand as manufacturing ramps up for the year. It also aligns with the solar panel production cycle, which peaks in spring and early summer ahead of installation season. What this means practically is that by late March, we'll start seeing the first drawdowns from available inventories to meet these contractual obligations. Exchange warehouses, dealer inventories, and refinery stockpiles will begin moving metal into industrial channels that won't return it to the market. If you're watching silver, April becomes a critical month, not because something dramatic will happen on a specific day, but because that's when the mathematical reality of reduced availability starts showing up in physical markets. Premiums on coins and small bars may rise, delivery times may extend, dealers may implement allocation systems. These aren't predictions. They're the logical consequences of supply and demand imbalances, and they're the kinds of signals that sophisticated investors watch, because they precede price movements, not follow them. The single biggest misconception about silver is that it's just a smaller, more volatile version of gold. It isn't. Gold is a monetary metal with industrial applications. Silver is an industrial metal with monetary characteristics. That distinction matters enormously. Gold's value derives primarily from its role as a store of wealth, a hedge against currency debasement, a central bank reserve asset. Industrial use is minimal. If every smartphone and computer on Earth stopped using gold tomorrow, the price would barely notice. Silver is the opposite. It's the most electrically conductive element, the most thermally conductive, the most reflective. It's irreplaceable in countless applications, from solar cells to medical equipment to water purification. And demand for these applications is growing, not shrinking, as the world electrifies and seeks cleaner energy. This creates a fundamental tension. Silver needs to be cheap enough for industrial users to afford, but valuable enough for miners to profitably extract. For years, the price has satisfied neither group particularly well. Miners struggle with marginal economics. Industrial users complain about volatility. And investors, caught in the middle, watch a metal that should logically be rising trade sideways for years. But when supply constraints force price discovery, that tension resolves, and it doesn't resolve politely. Another misunderstanding: the belief that governments and central banks don't care about silver because they sold their reserves decades ago. That's backwards. They sold because they didn't need monetary silver in a fiat currency system. But they absolutely care about industrial silver because modern economies depend on it. This approval isn't a financial decision, it's a strategic one. And strategic decisions signal what governments actually value, regardless of what they say publicly. History offers patterns, not predictions, but the patterns are instructive. When physical commodity markets face genuine supply constraints, the progression tends to follow a sequence. First, insiders and institutional buyers notice. They don't announce it. They simply adjust their behavior, securing supply quietly, extending contracts, building inventory. This phase is invisible to most observers because it happens in private negotiations and warehouse data that few people monitor. Second, premiums begin to diverge. The gap between spot price and the cost of physical delivery widens. Dealers start charging more. Wait times extend. Smaller buyers get squeezed first because larger buyers have relationships and contracts that protect them. Third, the paper market begins to notice. Traders see the physical tightness reflected in delivery demands, warehouse drawdowns, and shifting futures spreads. Volume increases. Volatility picks up. Price starts moving, initially in fits and starts, then more persistently. Fourth, media coverage begins. At this point, the move is already well underway. By the time general financial news outlets report supply concerns, sophisticated buyers have been positioning for weeks or months. Fifth, retail interest surges. This is the dangerous phase, because new buyers entering late often do so emotionally, without understanding the dynamics, and become the exit liquidity when the initial move exhausts itself. Understanding this sequence matters because it tells you where we likely are right now. Institutional buying has probably begun. Premiums are starting to tick higher. The paper market hasn't fully reacted. Media coverage is minimal. Retail interest is non-existent. If this pattern holds, we're still early. Not at the beginning, but before the middle. And that matters for how you think about positioning. You cannot understand what's happening with silver or any hard asset without understanding the monetary environment we're in. And that environment is unprecedented. Global debt has reached levels that would have been considered impossible a generation ago. Government debt, corporate debt, household debt, all expanding faster than the economic growth needed to service it. This isn't sustainable indefinitely, and everyone knows it, but the solutions are politically unacceptable. You can't tax your way out of this debt. The numbers are too large. You can't grow your way out, not without productivity increases we're not seeing. That leaves two options: default or inflate. Default is politically catastrophic. It means broken promises, shattered retirements, economic collapse. So instead, central banks choose inflation. Not the sudden, obvious kind that causes panic, but the steady, persistent kind that erodes purchasing power gradually enough that most people don't revolt. This is why real interest rates matter more than nominal rates. If inflation runs at 4% and your savings earn 3%, you're losing purchasing power. The number in your account grows, but its value shrinks. And when this happens persistently, people seek alternatives. Hard assets become those alternatives. Real estate, but property is expensive and illiquid. Gold, but gold has already repriced significantly. Silver, which offers similar characteristics at a fraction of the price, starts looking compelling. The currency pressure is global, not limited to any single nation. The dollar, despite its strength relative to other currencies, has lost over 95% of its purchasing power since the Federal Reserve's creation. Other major currencies have fared no better, and in many cases worse. This isn't a crisis, it's a trend. And trends, this powerful, create investment opportunities for those who position ahead of the crowd. If you've been holding physical silver, you've likely experienced frustration. Years of sideways price action, industrial demand growing, but prices not reflecting it. Paper market manipulation concerns. The constant question, am I wrong or am I early? What's happening now suggests you may have been early. That's not the same as being right yet, but it's different from being wrong. Your immediate priority should be understanding your position's purpose. Are you holding silver as a speculation on price appreciation, as insurance against monetary instability, as a long-term store of value? The answer determines what you do next. If you're holding for insurance purposes, nothing changes. Insurance doesn't become less valuable because the risk hasn't materialized yet. In fact, if supply becomes genuinely constrained, your insurance just became harder to replace. If you're holding for appreciation, you need to think about time frame and exit strategy. Supply disruptions can create sharp moves, but they also create volatility. Having a plan for taking profits, if that's your goal, matters more now than it did 6 months ago. If you're holding as a long-term store of value, this development reinforces your thesis. Scarcity enhances value. Reduced availability strengthens the case for holding. What you shouldn't do is panic sell because price hasn't moved yet. Supply constraints take time to work through markets. The approval happened. The deliveries begin in April. The market's recognition of what this means will come, but on the market's timeline, not yours. Patience isn't passive, it's active discipline. It's understanding that capital markets reward those who can wait longer than the crowd can remain solvent. If you've been watching silver but haven't bought, you're facing a decision. Not whether to chase a price move that's already happened, because it hasn't, but whether the structural case has strengthened enough to warrant position. Start by acknowledging what you don't know. You don't know if prices will rise next month or next year. You don't know if this supply agreement will cascade into broader tightness or be absorbed without incident. You don't know if other factors will overwhelm the silver story entirely. What you can know is whether the risk-reward has shifted. And objectively, it has. The supply side is tighter. The industrial case is stronger. The macroeconomic environment favors hard assets. The valuation, relative to historical ranges and relative to gold, suggests more upside than downside. That doesn't mean rush in blindly. It means consider whether a position makes sense as part of a broader strategy. If you decide to establish a position, think about how. Physical metal offers true ownership, but comes with storage and liquidity considerations. Exchange-traded products offer convenience, but introduce counterparty risk. Mining stocks offer leverage, but add company-specific risk. Each has trade-offs. Most importantly, size your position appropriately. Hard asset positions should be meaningful enough to matter if your thesis proves correct, but small enough that you can sleep if they don't. 5 to 10% of liquid net worth is a common range among investors who take these positions seriously without letting them dominate their portfolio. And whatever you do, don't buy because you're afraid of missing out. Buy because you understand the case, accept the risks, and have conviction based on analysis, not emotion. Markets test conviction, always. And the harder the test, the better the eventual reward for those who pass it. If silver does enter a supply-driven move, volatility will be extreme. There will be days when prices rise 10%, days when they fall 8%. Rumors will circulate. Commentators will declare the move over. Others will call for exponential gains. Your ability to navigate this depends entirely on your preparation before it happens. And that preparation is psychological, not just financial. Understand that volatility is not the same as risk. Volatility is price fluctuation. Risk is permanent capital loss. They often get confused, especially in the midst of sharp moves, but they're fundamentally different. Understand that other people's panic is not your emergency. When premiums spike and availability tightens, New buyers will rush in emotionally. That's when disciplined holders have options: hold, sell, or add strategically, but only if they're not caught up in the same emotional wave. Understand that markets exist to transfer wealth from the impatient to the patient. Every seller at a bottom regrets it. Every buyer at a top regrets it. The only way to avoid becoming one of them is to have a plan you developed when you weren't emotional, and stick to it when you are. The investors who do well in these situations aren't smarter. They're calmer. They've seen volatility before. They've held through drawdowns. They've resisted the urge to do something when doing nothing was the right choice. This isn't natural. Human psychology evolved to react quickly to threats. But financial markets reward the opposite: careful deliberation, emotional control, and the ability to think in years when everyone around you is thinking in days. If you can't do that, you shouldn't be in volatile assets at all, and there's no shame in that. Knowing your limitations is wisdom. Let me be direct about the mistakes you should avoid because they're predictable and preventable. Don't buy silver on margin or with borrowed money. The appeal is obvious. Leverage amplifies gains, but it also amplifies losses, and more importantly, it introduces forced selling. If you borrow to buy and price drops temporarily, you may have to sell at exactly the wrong time. This destroys more wealth than almost any other mistake. Don't chase price spikes. If silver jumps 15% in a week, your instinct will be to buy before it goes higher. Resist. Parabolic moves, correct. Always. The people who profit from spikes are those who bought before them, not during them. Don't believe price predictions. Not mine, not anyone's. The analyst who calls for $50 silver by June might be right, but probably isn't. And even if they are, they likely won't tell you when to sell. Price targets are marketing, not analysis. Don't ignore your broader financial situation. Silver, or any hard asset, is part of a financial strategy, not the entirety of it. You still need liquidity. You still need income. You still need diversification. Getting the silver call right, but destroying your financial stability in the process isn't winning. Don't panic sell on corrections. If you buy and price immediately drops, your brain will scream at you to get out. That's loss aversion, a cognitive bias that causes terrible decisions. If your thesis was sound when you bought, a price drop doesn't change it unless the underlying facts changed. Don't follow social media hype. The loudest voices online are rarely the most informed. They're simply the most confident or the most dramatic. Real analysis is boring. It's spreadsheets and supply data and macroeconomic trends. It doesn't come with rocket emojis and moon predictions. Don't forget taxes and costs. Physical silver incurs premiums when you buy and spreads when you sell. ETFs have expense ratios. Mining stocks have company risks. Factor these into your return expectations because they're real. And finally, don't invest money you'll need in the next year. Hard assets are long-term positions. If you need your capital back in 6 months, you're not investing, you're speculating, and the market has no obligation to cooperate with your timeline. Step back from silver specifically and consider what's happening across hard asset markets. Copper at multi-year highs, gold setting new records, uranium in a sustained uptrend, lithium volatile but structurally tight, oil range-bound but supply constrained. These aren't coincidences. They're symptoms of a broader shift in how capital is thinking about inflation, currency stability, and the physical limits of supply. For 40 years, the dominant investment paradigm has been financial assets: stocks, bonds, derivatives, digital instruments. The economy financialized, wealth became increasingly abstract. The connection between investment returns and physical production weakened. But you can't print commodities. You can't create silver through monetary policy. You can't quantitatively ease your way to more copper or lithium or oil. And as governments have learned, they can create unlimited currency. The value of things that can't be created has started reasserting itself. This doesn't mean financial assets are doomed. It means the relative value between paper and physical is rebalancing. And in that rebalancing, those who positioned in scarce, tangible assets before the crowd recognize the shift will likely benefit. Silver sits at the intersection of this trend. It's monetary enough to benefit from currency concerns, it's industrial enough to benefit from technological growth, and it's undervalued enough, both historically and relative to gold, to offer asymmetric upside if the thesis plays out. Understanding this bigger picture prevents you from getting lost in daily price noise. The fundamental story isn't about what silver does tomorrow. It's about what happens over the next several years as the global economy grapples with debt, inflation, and the physical constraints of an electrifying world. Information advantages used to come from access. Institutional investors had Bloomberg terminals and research departments. Retail investors had newspapers and newsletters. That gap has narrowed dramatically. Today, anyone can access supply data, warehouse inventories, futures positioning, and global production figures. The information itself isn't the advantage anymore. The advantage now is interpretation. It's understanding what the data means, not just what it says. It's recognizing patterns, understanding incentives, and thinking in systems rather than isolated facts. This approval, the $2.5 billion silver agreement, is publicly available information. Anyone can read about it, but most people will read the headline and move on. Some will buy impulsively. A smaller group will analyze what it actually means for supply dynamics, market structure, and future pricing. The returns go to that last group, not because they're smarter, but because they're willing to do the thinking that others skip. If you want that advantage, you need to study. Not silver specifically, but how commodity markets work, how supply chains function, how industrial demand develops, how monetary policy affects real assets, how market psychology creates opportunities. This knowledge compounds. Every crisis you study, every commodity cycle you analyze, every market dynamic you understand makes you slightly better prepared for the next one. And in financial markets, being slightly better prepared than the average participant is often enough. The investors who succeed long term aren't those who make one brilliant call. They're those who consistently avoid terrible mistakes and occasionally position themselves well ahead of obvious opportunities. That requires knowledge, discipline, and emotional control. You can develop all three, but only if you're willing to treat investing as a skill worth learning, not a game worth playing. The hardest part of investing isn't the analysis, it's living with uncertainty while your capital is at risk. You will never have perfect information. You will never know for certain how events will unfold. You will always be making decisions with incomplete data, and you'll only know if you were right in hindsight. This is uncomfortable. Human beings crave certainty. We want guarantees. We want to know that if we do X, Y will happen. But markets don't work that way. The best you can do is think probabilistically. Not silver will definitely rise, but given current supply dynamics, historical patterns, and macroeconomic conditions, the probability of significant appreciation over the next 18 months seems higher than the probability of significant decline. That's not as satisfying as a prediction, but it's more honest. And it's how professional investors actually think, even if they don't always communicate that way publicly. Thinking probabilistically also helps with position sizing. If you believe there's a 70% chance silver appreciates meaningfully and a 30% chance it doesn't, you should size your position to reflect that uncertainty. Not all in, not absent, but calibrated to the probability you assign. It also helps with emotional management. If you acknowledge from the start that your thesis might not work, you're less likely to panic when the position goes against you temporarily. You expected that possibility. You planned for it. It's not a crisis. It's a scenario you accounted for. Uncertainty is the price of admission to markets. The compensation for accepting it is the potential for returns that exceed what safe, guaranteed investments provide. But you only get compensated if you can actually tolerate the uncertainty long enough for your thesis to develop. If you can't, there's no shame in staying in safer assets. But if you can, the opportunities available to those willing to live with uncertainty are substantial. There's a saying in markets, timing is everything. It's also nothing. Both are true. Timing matters because buying low and selling high maximizes returns. Obvious, simple, nearly impossible to execute consistently. Timing doesn't matter because good assets held long enough tend to reward patient holders regardless of entry point. Buy gold at the wrong time and you might wait 5 years to break even, but wait 10 and you're probably fine. With silver, specifically, timing has been particularly treacherous. The metal has long periods of doing nothing, followed by explosive moves that give back half their gains. Trying to catch the bottom and sell the top has destroyed more capital than just buying and holding. But timing also matters in terms of risk-reward. Buying silver at $30 offers a different proposition than buying at $18. Not necessarily worse, but different. The lower the entry point, the more room for error. Right now, silver sits well below its inflation-adjusted all-time high. It trades at a gold-to-silver ratio that, historically, has proven unsustainable. It faces supply constraints that are developing, not yet fully priced in. From a timing perspective, this isn't perfect, but it's reasonable. Perfect would have been buying 2 years ago, but you can't change the past. You can only make decisions with the information available now, and now the setup looks more favorable than it has in years. Not certain, not guaranteed, but favorable. If you've been waiting for clarity, you'll be waiting forever. Markets don't provide clarity. They provide probability distributions and incomplete information. You make decisions anyway. The question isn't whether this is the perfect time. It's whether the risk-reward justifies a position at current levels, given your situation, your goals, and your risk tolerance. For many thoughtful investors, the answer is yes. But only you can make that determination for yourself. The most valuable thing you can do right now isn't buying silver or any other asset. It's preparing your mind for what comes next. We're entering a period where the assumptions that guided investing for decades may no longer hold, where currency stability can't be taken for granted, where supply constraints matter more than monetary policy, where patience gets rewarded and speculation gets punished. Some people will thrive in this environment, others will struggle. The difference won't be intelligence or luck, it'll be preparation. Prepare by educating yourself about how money actually works, not how you wish it worked. Prepare by understanding that markets exist to transfer wealth from the reactive to the deliberate. Prepare by building positions before you need them, not after everyone else realizes they need them too. Prepare by accepting that you'll be wrong sometimes and having systems in place to limit the damage when you are. Prepare by recognizing that the crowd is usually wrong at extremes, which means being right often feels uncomfortable. The silver development, this $2.5 billion approval, might be the catalyst that changes everything. Or it might be a footnote. You don't know. I don't know. No one knows. But if you've prepared, you're positioned to benefit if it matters, and you're protected if it doesn't. And that's the best any investor can do. The crisis, if there is one, isn't here yet. What's here is an opportunity to think clearly, act deliberately, and position yourself for a future that increasingly favors those who understand the difference between real assets and financial abstractions. What you do with that opportunity is up to you. Stay informed. Stay disciplined. And remember that in markets, as in life, understanding what you don't know is often more valuable than being certain of what you think you do.